You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Chris, looking forward to this conversation. Why don't you introduce yourself to the audience?
Sure, Peter, I'd be happy to. I'm a research scientist by training. I got my PhD from Duke University in toxicology, worked with neurons, did the research thing for a while. I was not paying much attention. I was a genius like everybody, got wealthy, and then promptly lost quite a bit of that so-called wealth because I was listening to my broker, and I started getting curious, and I looked into the economy, got really concerned by what I was seeing there, long-term big picture stuff, where the United States is headed with debt entitlement programs, things like that, money printing. And these were quaint numbers back then. And then my curiosity led me to connect economy, energy, huge story there, not just for the United States, for the whole world. It's going to be a very interesting next few decades. And then also the environment. When I put all three of those E's in one spot, it really led to some profound changes in my life. I quit my job, started a blog, a terrible career move, but it all worked out. My mission and my money are in the same spot now. I'm out trying to warn people, tell people, educate people about the big picture changes that are, and that's what I do now.
So, Chris, I know you talk a lot about resource depletion, and I also know that you view yourself as almost like a futurist as well. So I need you to put on your technological futurist baseball cap on, and I need you to put on your resource depletion baseball cap on as well. Where's the crossroads here? Does technological innovation prolong the resource depletion, or does it not open up whole new opportunities? And perfect examples like that is like the shale boom, for people talking about freshwater depletion. Is it not inevitable that you can, garner and harness ocean water, for example? And if resources are being depleted with things like private commercial space orbit flight, that things like technology can always find the solution in some shape or form, especially if the payoff in the commodity is valuable enough.
Well, it all comes down to really understanding energy and the role of energy. And so from a scientific perspective, all organisms grow into the available energy that they have. And so here's a quick way to look at this. As recently as 100 years ago, farming was a 10-to-1 positive return activity. So farmers would go out, they would expend 1,000 calories, and they would grow 10,000 calories, keep 1,000 to keep themselves going. They have 9,000 surplus. So that's when you ask from 100 years ago beyond, you ask who's the wealthiest people? Well, they were all the people who owned the land, because that's where our primary energy source came from, and food being our primary energy source as humans. Today, Peter, that ratio is exact upside down. There are 10 calories of fossil fuel baked into every calorie that you and I eat. And it's the proverbial fish in water. People are so surrounded by this abundance, they're not even aware that it's there, but it's there in every single thing. So we wander over to technology. People say this to me all the time. Oh, we're going to have solar freaking roadways. Tesla has a power wall. And when we look at these, you just have to get a single chart out, look at total energy consumption, quadrillions of BTUs. And this is from everything, right? You got fossil fuels, which is coal, oil, natural gas. You got hydro, you got nuclear. What do we do then? This is where I see challenges, but there's opportunities, because I think we're going to have to configure vast portions of our society in terms of how we move ourselves, how we feed ourselves, where we live, how we live. People who can see that coming in advance, I think, could position themselves. So I don't try and predict the future. I just look at the trends, right? Here's a trend. Guess what? Entitlement programs are really going to bite us at some point. Retirees are going to get left, which is going to be painful. Taxes are going to go up. That's not a prediction. That's just telling you, that's just what the math says. It's a trend.
Let's take it back because you've already mentioned entitlements, and I wanted to highlight to you. I want to tell you something. Is number one is I have your crash course video series on my BlackBerry. Actually, I carry it almost everywhere. I don't get a chance to watch it as much as I like to, but I do have it there. And for anyone that is not familiar about the crash course series, how about we try to give the audience like a synopsis on some of the economic paradigms that you discuss about?
Oh, I'd love to. So the crash course was sort of my magnum opus. It was many years of thinking, and what it does is it says, look, we can't just look at the economy in isolation anymore. The economy, if we put this much money in, we'll get this much, economic activity. Guess what? Things aren't working like they used to. And my explanation for that is that you have to understand that the economy is actually a subset of the energy that we produce, not the other way around. And so once you connect the economy with energy, here's a really interesting insight. Our economy is something that we want to grow. And every time you read about it, whether it's a Treasury Secretary statement, a Federal Reserve statement, a President statement, whatever, we want more jobs. We'd like to see 10% more homes sold, 3% more cars. Whatever it is, we're looking for the economy to grow by some percent, 5% a year, 2% a quarter, whatever the numbers are. Well, the interesting thing here is that anything growing by some percent over a unit of time is growing exponentially. And this is a really powerful and important concept because let's look at it this way. China growing at 7% per year means that if we use this handy thing called a rule of 72, we divide 7 into 72, and we discover that every 10 years, China is going to be completely doubling its economy with 7% growth. So think about that. 10 years, we're going to double China's economic consumption of everything, coal, copper, cement, steel, you name it. And so this idea of exponential economic growth is embedded in every culture on the planet. Everybody wants economic growth. But when we wander over to the energy side of the story, it gets really fascinating because you can't grow an economy without growing your energy. If you don't have energy, you don't have any economy whatsoever. So when we look at that, the first question we should ask ourselves is, look, the world's got $200 trillion of outstanding debt. It's expected to pay all of that back, piling more debt on. That means we're making a big collective bet that the future is going to be bigger than the present. Well, the first question we should ask is, hey, is the energy going to be there? It's a very simple connection to make. It's almost never made. The assumption is the energy will always be there. But I can show you reams and reams of data that says, here's when the world production of oil is going to peak. Here's where the net energy from oil probably peaked. Here's the net energy per capita is the most important number that we can have. That's been falling for quite a while now. I think it explains a lot about what's going on in our world. So just connecting those two dots, the economy and energy, Peter, I think gives you both explanatory power. It helps you make sense of what we're seeing in terms of stubbornly low growth, high unemployment, things like that. But it's also predictive, because it gives you a chance of assessing for yourself whether you think it's likely or not, and we can have different assessments about whether we're going to get the energy we want, require, expect to support the type of economy that we've piled all of this debt around in anticipation of it coming. And then the third E is the environment, which is taking things from the natural world and also putting things back in. And there, I have to tell you, there's a whole slew of very somewhat depressing statistics around. And so we look at the environment, we say, wow, this is we not only can we not take things from it forever. The sardine fishery just collapsed in the Pacific Ocean. That's a bad moment. And the cod fishing has collapsed and gone from the Atlantic Ocean. That was a bad moment. These are things that we can start to stack up and say, look, it's clear that either humans are going to have to really shift their narrative about how we interact with the natural world and make it our story can't be around just the economy anymore. We have to take these other pieces into event. We have to do some adult-sized long-range planning. And unfortunately, I don't see any of that happening at the government level. So it means you and I and people listening to this have to do some planning on our own.
Now, Chris, based on all of these trends that you're observing, does this put you under some kind of like economic paradigm in which you prefer a particular model over the other?
Well, so the response that we take at my website in the community is called Peak Prosperity. What we do is we start with financial wealth as the starting point for the conversation, and we say, look, if all you have is money, you're poor. Right? Because money comes, money goes. And right, they had a lot of money and they were worried about losing it and they were scared. And anyway, financial wealth is just one form of wealth or capital. There are 7 other forms of capital, and we like people to diversify. So another form of capital that I can look out my window and see on my property is what we call living capital. So I've got a garden, I've got an orchard, and I pay money to have extra compost brought in. So I take my financial capital and I turn it into enhanced living capital. Material capital are the investments I make on my homestead with solar, hot water, solar photovoltaics. Great returns, actually. Better than I can get on Wall Street for sure. Social capital, very important. Who do you know? How well do you know them? Who can you really rely on? Build those ropes, those threads with your community. Very important. I think one of the more important ones. And emotional capital. You know, we've seen again and again that when financial or economic crises happen, it's actually not the financial or economic crisis that hurts people, it's the reaction to it. That's what I've done in my own life, and that's what a lot of people in our community have done, is truly diversify. It's not just having some global equities and a muni treasury bond ladder.
Chris, so we talked about personal finance. We discussed a little bit about some industries and resource depletion and some of the bigger trends that are happening. I also know you follow geopolitics a little bit. What are some things that you're looking at in terms of geopolitics?
Well, it's been absolutely astonishing to me. And so the United States policy in Ukraine has been absolutely, if you just take a little time to study it, you'll discover that we had our fingerprints all over what happened in the Maidan revolution or unrest that happened that led to the downfall of Yanukovych, who was the then sitting president. And he was pretty much booted from office by the United States and Western allies because he didn't sign the European Association Agreement back in November of 2013. By February 2014, he's gone. The rest is history. The United States has been saying that it's all Putin's fault. It's clearly not. There's a lot going on there. And so the part that's really mysterious to me in that whole story is that Putin controls roughly 30% of all the gas that Europe consumes. Europe has no second plan B for how they're going to get the gas that they need to run their countries.
In terms of the alternatives for Europe in this situation, it seems as if the perfect partner in this case would be the United States. Because I even find that in terms of LNG, let's just say LNG shipments around the world, countries like Australia and Qatar are in a much more advantageous position to be exporting to the Asian nations. Now, where does that leave the United States, especially considering their ability to export logistically would be very far to some of those other countries? It seems as if Europe might be the inevitable destination, and that would be more of a collaboration amongst the NATO allies from that perspective. And another point in terms of China, for example, that agreement that was signed in terms of the deal, believe it or not, there was a period of time we actually had an investment in Gazprom, so we followed this quite extensively. The deal was not as big in terms of magnitude as initially anticipated. So despite the number sounding as phenomenal, financial analysts actually looked at it and just said, that was less than stellar anticipation as far as the abilities for Gazprom to replace the revenues out of Europe into China.
From a revenue deal, I only look at it in terms of supply. The whole idea of the LNG exports from the United States, this is kind of a murky area because cheap natural gas, everybody and their uncle who could has been building a natural gas consuming device, be it a power plant, an ethane plant, even a gas to liquids. Things were on the drawing board but got scrapped, but who knows, right? So a lot of consumption coming up. And so I look at the natural gas story, and I have some question marks about whether the United States will ever be that powerhouse exporting partner that Europe could count on. If I'm Europe, I'm probably going to count on Qatar. I'm probably going to count on trying to get my gas from somewhere else, because I don't think the United States is really going to be in a position to be a dominant supplier.
Now, Chris, I know you've had a conversation with Porter Stansberry as well, and I think he continues to even tout the fact that you guys had this great debate about peak oil, and everyone has their own different view on this. But I guess referring to market, because I try to be as agnostic to this as possible. When you take a look at natural gas prices, at least on the NYMEX, for example, there seems to be almost a consensus, especially from a price perspective, that, hey, gas is going to be abundant over the next several years. And if you look at future forward contracts, it seems to reflect that at that juncture. Now, obviously, there are various different research studies and reports that have potentially conflicting views. Why do you think the market is behaving the way that it is, and why is it so extremely bullish about this whole shale revolution, and the equities in that space seem to reflect that, and the natural gas price on NYMEX at least seems to reflect that, and the international prices seem to just be where they've been over the last few years already?
From an investing standpoint, I'm much less bullish on the shale revolution for a variety of reasons. The first is that, in any mature industry, I love to see positive free cash flows. I really dislike accounting shenanigans. I really like my numbers clean and clear. And it's one of the things I look at is free cash flow all the time. So the shale industry right now is pretty mature, because the average shale well depletes 85% within the first 3 years, sometimes as high as 75% in the first year, right? So by the time you're 3 or 4 years into your drill program, you should be starting to hit some sort of a steady state, right? And what we saw was that from 2009, 10, 11, 12, 13, I don't have any data for 14 yet, but it's going to be worse because we had the price plunge in 2014. For all of those years, oil was either rising in price or safely over $90 to $100 a barrel. Of the 80 companies that I follow in the shale space, collectively, they had whopping, massive, negative free cash flows every single one of those years. I want to see positive cash flows. You look at the amount of debt they took on, right, because they bought Kodiak, so they're sitting on $5.8 billion total debt.
That leads to that fantastic question, though, Chris, is that, what are the geologists indicating in terms of potential supply for, let's say, some of these E&P companies or anyone that's building up infrastructure? Because as you know, I generally believe that capital makes people much more efficient, and who is willing to provide that much capital outlay if there's not such a clear trajectory on, the supply of LNG that they could actually produce to build up all this infrastructure? One of the companies that we look at is actually Kinder Morgan. We built a fantastic position. Its balance sheet is probably a lot more superior to many of these other companies that we're talking about. And they're actually building the toll road for the transport of LNG throughout the nation. So how does that work, in which, executives and geologists work in tandem to assess, the feasibility of many of these projects, and then, invest this amount and put their balance sheets in those situations without seeing potentially light out of the end of the tunnel?
Well, I think the picks and shovels approach is the right one to take here. To me, there's no question. Here's what's going to happen. First of all, oil has to go up in price, and gas has to go up in price. Natural gas, because simply they are below their all-in cost of production. No commodity, but especially not, can ever hang out below their all-in cost of production for very long.
What's the all-in cost for oil and natural gas in the United States right now, in your opinion?
So it really depends by the play, but averaging across them all, the number I'm most comfortable with is about $7.50 per therm for natural gas. And it's probably around 80 to 85 sweet spots in the shale, but it goes up rapidly from there.
Okay.
So the Utica oil play, when they're getting 30 barrels per day out of the wells, you need, $300 to make, but they're just not viable. You saw this, right, with Bell pulling out of the Mississippi Formation in Kansas and yada yada, right? So the sweet spots, I'm pretty bullish on. The less sweet spots are going to command a higher price. So when people say, how much are we going to get out of the Bakken? I'm like, I don't know. If oil goes to 200 a barrel, we'll probably get twice as much as even the EIA thinks, which is, I would put that probably closer to 7, maybe 8 billion barrels coming out of that play at the right price. But it's got to be at the right price, and today isn't the right price. So, a lot of the whole shale dynamic, one of the things that's played into this was the Federal Reserve driving interest rates so low that people were yield starved, so they chased a bunch of yield. It never made sense, Peter, to have certain of these shale operators who had just marginal plays at the edge. Anybody who scratched at them could find out just how marginal they were, getting junk rollover financing at 5%. It was just nuts, right? But that's what markets are for. People will discover just how nuts and are beginning to figure that out. I'm very bullish on these things, but not these prices. When the prices are right, good operators, better operators, force funds, all of that, that's what this shakeout's going to give us at this point in time. We'll go after these things, but not until the price, not in the same pace we did, let's say, even a year ago, not until we see much higher prices and those are stable for a while. I think there's a bit more caution in the field right now.
So you're saying that a byproduct of this is basically loose money due to the environment that has basically got people to chase yield and return. And as a byproduct, this industry, or at least this whole shale revolution, has been a benefactor of that.
Oh, absolutely. Absolutely. That plus a really, really low cost of capital. Right. If you have more normal cost of capital, the IRRs on these projects clearly drop off pretty quickly, just like any other industry. So the cheap cost of capital, the absolute flood of liquidity, yield starts.
Well, Chris, it's been a fascinating conversation. I suggest maybe we do a podcast again sometime soon to discuss more about more of the chapters, I guess, of Crash Course and to get an update on where we're at in terms of geopolitics.
Love to. That would be a lot of fun.
Well, thank you, Chris. Talk to you soon.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.